We've touched now upon on the fundamental picture, but I want to switch gears and talk about the technical. I mean, what drivers are we seeing in the market today, and how might that impact performance going forward?
I think shifting over from investment grade in the corporate market and thinking more about asset-backed securities, CLOs, and CMBS, we're seeing the same dynamics. New issue concessions are non-existent. Everything is tightening through guidance, and then we're seeing test levels. Subscription levels are extremely high. It's very challenging to get allocations across all areas of securitized products. So, and then on the follow in the secondary market, stuff is trading up, and the demand on after new issue is extremely high. So yeah, I mean, technicals across all credit markets are very strong. It's really as simple as there's just more demand than supply. And Scott hit on many of the new the new demand levers. Insurance companies, annuities are huge, and then what's going on in private credit and asset-backed securities. That is, every incremental dollar that's trying to access credit is crowding out an investment for someone else. And demand for there's plenty of supply of treasuries, and so that you have that dynamic too. But from a pure credit perspective, it's a challenging time, but it makes sense. Scott alluded to, and we've talked about, fundamentals are very strong. The Fed is cutting rates. We have a very pro-business administration, and the outlook for 26 in terms of fiscal spending is good. So it is what it is. So we can't forecast it. That's what makes markets so great, is they always change. As challenging as this environment seems, like, it will change, and typically something fundamental will drive a shift in demand before the amount of supply can adjust, and that oftentimes leads to opportunity for those that can react quickly.